wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you informed of the latest developments in the financial markets with a view to helping you make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 171. And in this episode, we're reviewing the performance of the financial markets during the 31st week of 2025, and that is from Monday the 28th of July to Friday the 1st of August. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Federal Reserve voted to keep its benchmark policy rate on hold despite continued criticism from President Trump and dissent from two members of the committee. The Federal Open Market Committee, which sets the overnight borrowing rate, voted 9-2 to keep the policy rate on hold. This means that the federal funds rate will remain at the current range of between 4.25% to 4.50%. This determines the rate that banks will charge for overnight lending and also informs the rate that banks use to lend to corporates and consumers. As mentioned earlier, two members of the rate-setting committee voted for the Federal Reserve to start easing monetary policy, given that inflation now appears to be under control and the labor market is beginning to show signs of weakness. Staying in the United States, the U.S. labor market is beginning to show signs of weakness as the growth in jobs came in lower than expected in the month of July, and the unemployment rate also ticked higher as President Trump announced a new round of trade tariffs. The Bureau of Labor Statistics reported on Friday that Nonfarm payrolls, which measures the number of new jobs created in the U.S. economy with the exclusion of farm workers, this recorded a seasonally adjusted growth of 73,000 new jobs in July, which was way below the Dow Jones estimate for 100,000 new jobs. In addition to that, the non-farm payrolls data for the months of May and June were revised down sharply by a combined total of 258,000 fewer jobs than was previously reported. It therefore comes as no surprise as the unemployment rate rose to 4.2% in the month of July. The weak jobs report for July could provide an incentive for the Federal Reserve to lower interest rates at its next policy meeting in September. According to data from the CME Group, futures traders have raised the probability for a rate cut in September from 40% up to 86%. And in a shocking and unprecedented move, a few hours after the jobs report was released on Friday, President Trump announced that he had fired the commissioner for the Bureau of Labor Statistics, accusing her of being a political appointee who was manipulating the jobs data. Over to the Eurozone, where according to flash data from Eurostat that was released on Friday, Eurozone inflation remained unchanged but at a higher than expected rate of 2% in the month of July. Economists polled by Reuters had expected the rate of inflation to dip to 1.9% after a reading of 2% in the month of June. The data also showed that the core rate of inflation, which strips out volatile food and energy prices, this came in at 2.3% in July, which was the same rate as the 2 previous months. Meanwhile, the closely watched services inflation rate cooled off to 3.1% in July after picking up slightly at 3.3% in June. The European Central Bank kept its benchmark lending rate on hold at 2% during its last policy meeting in July, and according to LSEG data, the markets are now pricing in about a 94% chance that the central bank will maintain its current policy stance at its next meeting in September. On Wall Street this past week, stocks tumbled on Friday as investors weighed on signs of a weakening U.S. economy as the July jobs report came in way below expectations and as President Trump launched a new wave of trade tariffs. This latest jobs report has increased the probability that the Federal Reserve will cut interest rates sooner than expected in order to prop up the U.S. economy. According to CME's Fed Funds Futures, traders are now pricing in about an 86% chance for a September rate cut. The Dow Jones Industrial Average recorded its steepest decline since the 13th of June as it dropped by 542 points to close at 43,588. Meanwhile, the S&P 500 posted its worst day since the 21st of May as it fell by 1.6% to end the session at 6,238, whilst the tech-heavy Nasdaq Composite registered its largest correction since the 21st of April as it declined by 2.2% to finally settle at 20,650. In the U.S. government bond market, U.S. Treasury yields tumbled on Friday after a weaker than expected jobs report for the month of July, in addition to a new wave of trade tariffs that were announced by President Trump on Thursday. The weaker than expected jobs report for the month of July and the significant downward revision for the months of May and June, this has increased the probability that the Federal Reserve will cut interest rates at its next policy meeting in September. In response to this data, the yield on the 2-year Treasury note plunged by more than 25 basis points to perch at 3.69%, whilst the yield on the benchmark 10-year Treasury bond dropped by 13 basis points to settle at 4.23%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the dollar lost ground on Friday and was on track for its biggest daily loss against the yen since January 2023. Dollar weakness was triggered by a weaker than expected jobs report for the month of July, which increased the probability that the Federal Reserve would cut interest rates sooner than expected. The Fed has previously indicated that it was in no rush to cut interest rates due to concerns that President Trump's tariff policies will reignite inflation over the coming months. The dollar index, which measures the value of the greenback against a basket of other major currencies, this was down by 1.23% on Friday with a reading of 98.80. The euro rose by 1.3% to trade at $1.1571 to the euro, as the Japanese yen appreciated by 2.2% to trade at 147.37 yen versus the dollar. In the commodity markets, the price of U.S. light crude oil fell by about $2 a barrel in early trade on Friday, driven by a possible increase in production by the Organization of Petroleum Exporting Countries. People familiar with the discussion amongst OPEC members and its partners said that there was a tentative agreement to boost production by 548,000 barrels per day in the month of September. On Thursday, President Trump imposed a new round of tariffs on various countries that had failed to reach a trade agreement with the U.S. by the deadline date of the 1st of August. With these tariffs expected to take effect from the 7th of August, traders were also focused on the potential impact that these tariffs will have on oil prices going forward. In response to the foregoing, the price of the global benchmark, Brent crude, fell by about $2 to close at $69.67 a barrel, whilst the price of the U.S. benchmark, West Texas Intermediate crude, was down by $1.90 to settle at $67.33 per barrel. In the precious metals market, the price of gold rose by 2% on Friday, hitting a one-week high after a weaker-than-expected jobs report for the month of July boosted expectations that the Federal Reserve would cut interest rates, and as a wave of new trade tariffs by the U.S. ignited safe haven demand for bullion. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular coupon like a bond. The price of spot gold hit its highest level since the 25th of July, rising by about 2.1% before coming to a close at $3,359 per ounce. In the cryptocurrency market, the crypto market slid on Friday after President Trump unveiled a new wave of tariffs on various countries that had failed to reach trade agreements with the U.S. by the deadline date that was set on the 1st of August. The decline in the crypto market triggered a wave of long liquidations, which forces traders to sell their assets in order to settle their funding accounts, and in the process pushes prices even lower. According to CoinGlass, Bitcoin recorded about $228 million in liquidations across various exchanges over the past 24 hours, whilst Ether saw about $262 million in liquidations. President Trump's announcement of a new wave of trade tariffs has sparked a risk-off sentiment, triggering concerns about higher inflation and limiting the Federal Reserve's ability to cut interest rates. For your information, the term risk-off refers to the market sentiment where investors become cautious as they reduce exposure to risky assets and move into safer and more stable assets. During such periods of risk-off sentiment, investors tend to dump crypto assets as they are considered a more speculative and volatile asset class. In response, the price of Bitcoin fell by 3% to settle at around $113,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where according to data from the Kenya National Bureau of Statistics, the annual rate of inflation as measured by the Consumer Price Index came out at 4.1% in the month of July, which was an increase from a rate of 3.8% in the previous month of June. According to the data, the overall rate of inflation was mainly driven by higher food and fuel prices. The core rate of inflation, which excludes volatile food and energy prices, this increased by 3.1% in July, up from 3% in June. Meanwhile, non-core inflation, which includes all components of the Consumer Price Index, this increased by 7.2% in July compared to a rate of 6.2% in June. In the domestic foreign exchange market, during the past week, the Kenya shilling continued to hold steady versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24 compared to a rate of 129.26 that was recorded the previous week. Meanwhile, the sterling pound was priced at 170.58 and the euro was valued at 147.65. And on the regional front, one Kenya shilling was changing hands for 27.74 Ugandan shillings and 19.89 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.18. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined slightly by $57 million for a grand total of $10.69 billion, which is equivalent to 4.7 months of import cover. This level of reserves is still in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.61% and was pretty much in line with the central bank rate at 9.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 4.4 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 31st of July, and the central bank received bids totaling to 16 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 67%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate remained stable at 8.11%, whilst the 182-day rate dipped by about 1 basis point to settle at 8.40%, and the 364-day rate was flat at a weighted average rate of 9.71%. Up next is our topical issue. And this week, we're looking at the listing of the Talanta Stadium bond. Sports Kenya is the custodian of sports infrastructure in Kenya and owns the new Talanta Stadium. The Talanta Stadium is projected to cost about 45 billion shillings to construct, and this cost has been fully funded through the issuance of a 15-year bond with a coupon rate at 15.04%. This bond was issued in August 2025 and matures in July 2040. The Talanta Stadium bond is amortized, which means that the principal will be repaid gradually during the life of the bond. Investors will receive 30 equal semi-annual payments, with each payment covering both the interest coupon as well as a portion of the principal. The bond's amortized structure will help to reduce interest payments to about 69 billion, which brings the total repayment on this bond to about 114 billion shillings. This bond has been issued by the Sports Fund, which is an entity set up through the Public Finance Management Act. The Sports Fund has a tenure of 10 years, which lapses in August 2028. The Sports Fund receives funding through taxes and levies imposed on the betting industry in Kenya. And as of June 2023, the Sports Fund had received a total of 10.6 billion shillings from the betting industry, but had only 5.6 billion shillings in assets. The Sports Fund, being the issuer of the bond, has the legal responsibility to ensure that the bond is fully serviced until maturity. However, given that the Sports Fund lapses in August 2028, investors are concerned about the repayment of the bond, which matures in July 2040. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com, Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, your time is limited, so don't waste it living someone else's life. Think about it. Thank you, and God bless.